Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here at the Ottawa Real Estate Forum with Aaron Cameron. I think we did miss last year, so we're happy to return in full force this year.
What did we miss last year?
I can't remember. I think it was a personal conflict, not a judgment on the city.
My daughter was being born the same weekend.
Yeah, personal conflict.
Yeah.
I hope your wife
Almost
does not hear
forgot.
me that way.
She doesn't listen. Don't worry.
Our first guest of the day is Sachin Anand, Senior Director, Acquisitions with the Regional Group.
Nailed it.
Yeah.
I had $5 on the line. He was going to screw that up.
Yeah. And the good news here for Sachin is he has complete and total domain over Ottawa market. And we have another guest today where we're going to talk about Ottawa specific kind of investment thesis topics. So he's the one. He's going to bring his, the top of his game in terms of knowledge. And this is it. If you're interested in investing in the Ottawa market, this is the takeaway from today to listen to. We have other great guests, don't be wrong, but Sachin, welcome.
Thank you for having me. A pleasure to be here.
How do you want to do this? Which food group do you want to start with first?
Well, do you want to set the stage? Sachin's expertise, the market presence.
Okay, sure.
How he got to
whatever you want.
here.
Whatever you want,
Yeah.
Adam.
Yeah.
Okay. Well, I'll start from the start. So, born and raised in Ottawa, so obviously very familiar with this market. Grew up in the West End in Nepean. Went to Scarborough Boarding High School for the people in the Ottawa crowd here. Then I went on to do my undergrad at McGill, did a finance degree, and also did an international business strategy minor, which was an exchange in France at a business school just outside of Paris. I also played lacrosse at McGill, so 4 seasons of fall ball there, field lacrosse on the men's team. Loved Europe so much, I actually moved to London, England after graduating, and I started with a French investment bank named Calion, which was Crédit Agricole, third largest bank in the world at the time, their investment banking arm. So I was stationed in London for the first year as an analyst, and was actually then moved to New York after that for about a period of 3 years, working in Manhattan for the same bank. After that, there's the big credit crisis that everyone may have heard about in 08, 09. It got me to sort of just think about what's my next step and next phase in life.
And were you in Europe at the time? Because
I was in New York at the
New York
time.
time, so we're hit much harder than
Epicenter.
Oh,
Yeah.
epicenter! Like I was walking by the Bear Stearns building on the way home. When
Oh, wow.
they're just announcing it's collapsing. Lehman Brothers as well.
How was the panic level at the time?
There was not a lot of transactions going on. I was in the capital markets side, so on the bond side and debt side, that was what was really getting annihilated with all the CDOs and securitization stuff. So there was a period of like 9 months where I wasn't really doing what I had previously been doing, which was waking up at 7 in the morning, going home at 3 in the morning, 6 days a week. It became a little bit more European in terms of, I guess, the takeaway for my day to day for a period.
So you're saying London's not like that, eh?
London is, but European. European vacation, as a starting package is just, it's like a senior VP over here. Like it's a minimum month. They force you to take it, and if not more time. So there's a little more focus on quality of life in that European. I think maybe that's one of the things that drew me to Europe. That plus traveling there a lot as a kid with my family. So then in New York, did investment banking for about 3.5 years. And after taking a period of time off living in New York, my wife was studying her PhD at Columbia University. I decided, hey, I got to start filling up the coffer here. I've been, burning cash living in New York. So then we were both from Ottawa. So eventually we were thinking, hey, we've been together 20 years now. At that point, maybe we were 7, 8 years into our relationship. We're thinking, hey, this is probably the time we're going to go settle down and have kids. And we're all from Ottawa. Our parents are all in Ottawa, so we have the family support. So we naturally migrated to make Ottawa back our home. So I moved back in 09. That's when I got into commercial lending at CIBC. So I did a year of diversified lending. And at that point, after the year, CIBC was actually looking to re-establish their real estate market in Ottawa. It was previously managed out of Montreal and London, Ontario. So myself and a gentleman named Carl Quinn were tasked with leading more the construction side of CIBC. So lots of towers, retail plazas, office buildings. We were financing it. It was booming at that time from 09 to 2013 in terms of new construction. And then about 5 years there at CIBC, I then transitioned to RBC, became a lender there, essentially focused on construction debt, but term debt as well. So I was able to keep the loan and the revenue that's created off the construction project as it becomes
Isn't that a beautiful thing?
property.
Yeah.
Well, it helps with, your portfolio, your relationships, your clients, they're here on one hand as a construction, then all of a sudden you're not the relationship manager once it's built. So I always found that a bit of a disconnect, but all the banks are a little bit different in how they set up their, the verticals for real estate, or, the profile for income versus construction risk, because it is different risk. And then fast forward that, another 4 years at RBC, we had a really good run there. I got a lot of leeway in terms of reestablishing the strategy for a group that was, I'm going to say, a little bit younger or underperforming at the time. They were known as a tech bank, and they weren't really known as a real estate bank. So they gave me a lot of opportunity to come in and, as a younger kid in the in the industry, show them what I got. And so we had a really good run, and going from less than 50 million a year in lending to a couple $100 million of lending a year as a team was really nice to see the presence and the growth. And I got to meet a lot of people in this room, or clients or prospects from there. And then from there, I moved to CMLS. So they had tapped me on a shoulder after syndicating a loan kind of internally with Desjardins. Sorry to say names. You can cut that part out. They just sort of said, hey, maybe you'll be a good broker. So I said, okay, well, that's another, arrow in the quiver. I've done construction lending, term lending. Now I can be a broker and act as a CFO for clients who maybe don't go to market for lending every day, but need an expert in that field, like a consultant who says, here's what the current market is, here's who the lenders are, here's what the spreads are like, your risk profile fits here or not. So yeah, CMLS as a broker was another way to grow, and that was a big step, leaving a bank after a decade and taking 100% commission based job with a young family in a new house. But anyways, the risk was worth it. I'm glad I had no regrets on doing it. You got to take risks to sort of grow and put yourself out there. And all along the way, I had one really good client, many clients, but one really good client that really stood out, on the top, three of my hand in terms of volume and real estate lending relationships. And that was the Regional Group. And so I'm at Regional Group now. It's been almost about 2.5 years. They brought me over to run and hunt essentially for income property and infill sites for them to build on and do their thing, because they were, it's a 65-year-old company, vertically integrated real estate firm. They do literally everything, in my opinion, except, student housing, hotels, and seniors housing, students, and hotels. So
those are all pretty profitable. Maybe it's time to start.
it's the profile of it. They're more operating businesses, right? So, we understand, bricks and mortars, put a tenant in there, understand the CapEx, but do we really want to be taking on the operational risk on a day-to-day basis or annual basis? It's not in our fold now. Maybe it's something.
Those are all specialized. Yeah.
100%. And those are where you really need an operation team that knows what they're doing. So, partnering with those, people, with those groups is, the way we would probably do it now, and look to grow in the future in, communities that we plan or master plan, where you're going to have a little bit of everything in there. It's not just homes, it's seniors, a school, and, making sure the community is really well-rounded.
A lot more can go wrong.
What more can go
wrong? A lot more can go wrong in those businesses. Yeah. Privately owned?
Privately owned. Run, I'm going to say it's the third generation now, 65-year-old company. A lot of started off as a brokerage. At one point, they were across Canada managing an external portfolio of third-party management. And then, I think it was late 90s, they actually, don't quote me on that year, but they started to sort of say, let's focus on our core market. It might have been because, one of the Lifeco or whoever they were managing for internalized their property management. So, you lose your Pan-Canada mandate, overnight, essentially. But yeah, no, I mean, out of that, I think they became stronger and more focused on their market, and, they are a strong leader here locally. People know them. We solve complex, large issues. We are long-term thinking master planners. Examples of that are like Citygate, which is an industrial master plan community, which you don't see a lot. Equinell and Kempville is one of our other master planned communities, but we're in like Rockland, Arnprior, Embrun, and then urban infill sites like Greystone Village, 26-acre sites that have a mixture of everything: low-rise housing to rental to retail. There's a school on site. I think Bruyere has a long-term care on site. So there's again a real focus on community and a real sense of pride in building not just a box to flip, but a community. So I think, that's what we kind of talk, that we're community builders, we're enriching communities, and that's kind of, the vision or the tagline.
And the family's from here, lives here.
Yeah, family. So we're all Ottawa based. Even it's there's family in the company too. So Tal Scher, Senator Gordon, Josh Kardish, David Kardish. I mean, it's a family business. So it's got that family feel, and I do enjoy working for them. And it was nice to switch from the lending side, being a sales side, to the buy side and seeing everything from a different angle and a different lens. and learning more about, the overall investment philosophy and thesis that goes into not financing a building, but buying it and making money.
There's a funny trajectory for your career, kind of going from big multinational and getting, CIBC and RBC, of course, giant institutions. CMLS is still an institution, not quite as big, obviously, as those banks, and then now to a sort of a smaller, family-run, Ottawa-centric. What's the change been like, or how could you explain or describe the differences?
Well, it's funny. So, I do mentor at McGill for the Commerce BCom program, and alumni of the lacrosse team. We do sort of mentor our lacrosse players coming up at McGill. And the common theme was, I kind of did things a little bit different. A lot of people kind of start at the retail bank, work up to commercial, and maybe get into investment banking. So you kind of go ground up. I actually went the opposite way. I started investment banking and started coming down into, I'm going to say, quality of life changes as I got older. And then it was, investment banking not sustainable, according to my wife, and she was probably right in realizing that, to commercial banking, using your same skills, but not being at the retail side where maybe it's a little bit less boring, a little bit more, in the box and just process oriented. So I enjoyed that. And then, going from, big companies, blue chip, which, don't get me wrong, those are names you want on your resume, right? You're building your brand personally. You attach with big brands, it opens doors, and it just allows people to say, oh yeah, I never take a call from RBC, but RBC's calling me. Let's just hear what they have to say. So, things like that really opened the door where, the companies I worked at had a brand recognition that I could leverage as well, and then showcase. And then CMLS was obviously a different type of platform where, you could do different things and be a little bit more creative than you could at the banks. And I come across as a creative guy. I like to sort of spin it that way. And it was just nice to be able to do things and structure deals more based on what the client's real needs were, and win deals because you're giving them something they want, not forcing a solution that, the bank
working at the bank, I've never, fortunately, no offense, worked at a bank, and but I hear the
Shots fired.
The requirements are, there's credit committees, there's committees on committees, and there's, all these very restrictive boxes for good reason, because there's regulations and these yield requirements based on the risk. And as I'm fully aware, commercial real estate is much more of an art, not a science, and those credit boxes don't really work great, right? And you're probably discovering that now where you are, where it's very much more of a gut instinct sort of decision making, which is a lot of commercial real estate success stories are built.
Yeah, my role now is to really, hunt for property, come up with develop the investment thesis, cost things out. Like, what's it going to cost? What's your leasing costs? What's your CapEx that you're missing? What's your acquisition costs? What's the yield? What's the exit? Is it capital?
Well, the assumptions, right? That's the art, not the science, right?
Exactly.
You've got to come up with why you think this is a good play in the future.
Well, we were saying that in the car ride over here, Aaron, talking about, adjust your assumptions, and every deal can work or not work, right? It's
yeah. Some people are better artists than others, I guess, is the way. Right?
People can paint a pretty picture, and then you guys still execute on that. Thesis.
That's
I think it's funny, as a lender, for about 14 years or so there, it was all tailwinds, right? Like, I at some point sometimes would be like, this is just too easy. Like, clients just throw in land, and CMHC comes with 95% loan to cost. They have to put no equity in.
Oh, the number of times on this podcast I've said rates come down, rents go up. Rates come down, rents go up. It's so good. Look how smart I am, right? Like, it's just.
So yeah, it was just there, lots of tailwinds, and I think what you saw with COVID and interest rate hikes is the headwinds came and labor costs shot up, and now all of a sudden the real estate players who know what they're doing are going to be able to differentiate themselves and prove that their knowledge, their know-how, and expertise is going to differentiate them from kind of everyone on the boat or the wagon, depending on what asset class you're in. So I really love my job, and I have a gut instinct on kind of what an asset should be, or if I look at something, what it could be, or how we're going to go about it. But the reason I joined Regional Group is they have experts in all of these different facets. So, vertically integrated, we have a land development team. We can take raw land and master plan it. We can rezone it. We can do development construction. We own property managed office, industrial, retail. We build. We have 6 buildings, rental buildings under construction. We have 1 condo building under construction. So we have property management, tax, and leasing. We can literally within our family or our group, I can go to experts in every single one of that and say, okay, Todd, I'm going to go buy this building. It's 50% vacant. I need your leasing assumptions. I need your assumption on what you're going to be able to do.
So that way,
and
if you're
achieve.
wrong, it's not your fault. It's someone else's fault.
And but yes,
Send that an email, please.
yeah, like you never want to be the one forcing something down, and then someone saying, "Well, I didn't pick this project. I didn't come up with the thesis." So I really like the fact that as a group, we really work together. We have experts that I respect, and I've seen different developers with different track records, and this is a group that always did what they said, executed, and the brand and reputation in the market is another great brand for me to be associated with and to improve my own
And
brand.
it sounds like you're having fun. Okay, let's do
Lots of fun.
let's do
Are we making money in
Yeah.
Ottawa? Is that the?
Yeah.
Well, is your schedule more Parisian or more New York right now in terms of busyness? We're in a downturn, hopefully coming out of it right now. How do you make your investments work?
No, I think so. We're very, let's call it New York. Penn's been up the whole time. We've been looking at opportunity. We are a bit more contrarian in terms of what we look for. I generally look for value add. So, a little higher risk, higher reward. If you're looking at IRR, sort of comparison or range, I want to be north of 14%, ideally. Do I want to be higher than that? Yeah, I'd love to put some 25s and 30s in there and, hit some triples and home runs. But some good solid singles are also really good too. But we're not generally a stabilized player. No value add. That's not really our cup of tea. Our capital likes to make money.
Do you hold on to it afterwards, or is it typically execute and flip?
No, I would say generally everything's made with the developed or bought with the intention to hold long term. We derive other fees off that. Property management and stuff like that. It's not lost in this room that there's property management fees. So the longer you manage an asset, the longer you keep an annuity of revenue and business coming. So my job is to grow more assets under management, grow the annuity on the PM side. So the more I buy, the more we acquire, and the more we grow, and the more fees and profit and revenue we can make, which is kind of the goal. Right?
What's your least favorite asset class? Right now, that doesn't be permanent. Just today in Ottawa, which asset class is your
So
least
I don't.
favorite?
Okay, so
Say office.
no, that's funny. Office is probably my favorite right now.
Oh,
Oh, okay, good. Well,
That's
we'll end
interesting.
there then. Okay.
So we'll end on that. So I mean, we can maybe go asset class by asset class, but in terms of where we play, in terms of high risk, high reward, there's some things that just don't make sense for us to be a buyer. So a lot of stuff like grocery anchored retail and stuff like that. I can't wrap my heads around the almost negative leverage or maybe the BIP of positive leverage you can get on that.
Where are they trading right now? Just generally in Ottawa. I know that's a real tough ask, but you're talking five caps kind of thing like that.
It totally
space?
depends. I mean, if you're single tenant, Shoppers Drug Mart, maybe you are in the 5.5 cap. I think if you're starting to get larger, you're starting to trade in the age of your property, the stickiness of the tenants, the WALT. All of these things are going to kind of factor into the cap rate and price per square foot. But retail is a bit of an anomaly that that cap rate is a cap rate based on very different retail rents, right? Like you could have a tenant paying $25 a foot. You could have a restaurant paying 40. You could have a drive-through paying $60 a foot. So it's very hard when you look at it on a cap rate basis to sort of say, I feel comfortable on that.
Especially if you're not a coupon clipper, like you just mentioned 40% IRR. Like that's not.
It's hard to do that when the brokers are telling you, hey, this is highly sought after, and there's nothing to do. There's no value add. There's no extra meat on the bone.
If you're 4 years into a 20-year shopper's lease, like what do you really do? Yeah.
You're just waiting. Unless and I'll caveat the fact that we would buy a stabilized property if it had excess land, or the ability to augment the building. So that is something we factor and we look into. So if there's an industrial building that has an extra acre, okay, let me put that one on my radar because maybe we can develop and build or be there for an expansion of a tenant or create the value by developing and building. So,
Yeah, something with a little catch to it.
Yeah.
Yeah.
So retail has been a little bit harder for me to justify.
What about sort of the second tier? Because the second tier down, there are some places that wherever you are in the
quality
country,
of the asset or quality of the geography?
Yeah, well, both. I mean, there are lots of well-located, sort of residential-centric retail strip plazas that just don't have the right ownership, the right makeup. They, bad tenant mix, poor management, or whatever. Right? That have. If you squint hard enough, you can see, a good retrofit.
Yeah, no, I think, in terms of strip mall, I think they have a lot of demand. They do serve, the residential uses around them. And, the things that you put in a retail strip plaza should be things you theoretically can't buy online. So things you have to go for, like a haircut, a nail salon, a massage, those kinds of
Flower
things.
shop, yeah.
Chiropractor, like all those things, right? So if you can get those types of tenants in there, you generally have a well-performing strip mall. Now, again, it comes back to rents and stuff. But on retail, like we would look at shopping malls and buying that because you get a large scale swath of land. In fact, we bought Hazeldean Mall a few years ago, and we've had a great turnaround success story there. So releasing it and getting new tenants in for a large vacancy when Target left. Again, that was a risk we took on from I think it was a Lifeco that had it. Where we just said we're local, we'll know that we know what we do here, and I think we can find the right tenant mix here as the local expert, where our tentacles are deep and long, and people know who we are, and they'll come to us with opportunity through the broker community or directly.
2 questions: minimum loan size, minimum deal size.
So land can go lower because again, you're buying raw land. It could be a lower dollar price. I'd say in terms of income property, commercial. I'm going to say, 10 million and above, but that being said,
Opportunistic.
it's opportunistic, right? So if it's selling for 5 million, but I can make it worth 15 million, yeah, maybe I'm going to take a look at that. So, I don't like to sort of pigeonhole me and say, there's a certain
If you
size.
get
Bring me.
you get a kick 25 IRR on $3 million bucks. Why not? Right?
What's the GIC rate there? Yeah. So, So that's it. So retail, it's been tough for me to justify some stuff, but yeah, I'd buy shopping malls all day long. They seem to be trading at a bit of a discount because shopping malls are a little less in favor, or maybe it's the tenant profile that they're not looking for interior mall space unless it's got their own doors. So you're seeing different trends evolve, but not a lot of new supply being built in retail either. So that's had the saving grace during COVID when everyone thought retail was going to get annihilated. Well, no new supply came on. It performed really well, and now it kind of came out as a gem, as a classic.
I mean, we've had that conversation. What do you know? Humans are social and want to get out and be around other people. Like it's just our nature.
Yeah.
Anyway, that's the foolproofness. I know that's not a word of real estate.
Yeah.
Ultimately, right?
So that's retail.
What's your third least favorite?
So industrial has been a challenge for me as well. That's been because of a few factors. One is the cap rates on industrial came down so hard in a period of 2-3 years. So again, negative leverage, right? Where my borrowing costs were 5.5% before, like last year, I couldn't justify buying it less than my cost of financing. At least that's not what we do. That being said, it's also tough to get the tenant pricing you need on a new build because the cost to construct is also up. So there's a trade-off there in terms of what's the tenant willing to pay and, what's the thesis again, what's my development profit versus a GIC rate, right? So
can you find land for it?
You can find land for industrial. I mean, it's more harder to find. It's in certain pockets of where industrial is, allowed or, zoned for. But that being said, there's a lot of large-scale industrial projects that have been put on or being, built spec. So my view on that is let everyone kind of go nuts on, the 1 million+ square feet of spec space that's being built. We don't need to compete on that. Once they're done, maybe we'll look at, bigger boxes, but I don't know if there's that much demand for.
I'm gonna say there's fixed
boxes.
tenants, right?
Yeah. I think a lot of them are going to have to carve up their space and go small bay. And again, small bay is not a bad strategy. It has a higher dollar per rent than the bigger box. So you just have some costs associated with subdividing your box into now 4 boxes. So maybe that wasn't in the pro forma. And then you just cap rates, conscious of that. Like if I'd signed up for an industrial deal, a year or 2 years ago and bought at a 5 cap, well, it might be a 5.5 cap today. So I lost money theoretically by doing nothing, even if I put new tenants in. It's just cap rate valuation. So,
well, what about the rent growth? I mean, 5 or 6 years ago, when industrial rent in Toronto was 4.25, or maybe 7 or 8 years ago, it was 11 or 12 here.
Mm-hmm.
So what's the growth trajectory been like, and what do you see for more room to grow, if anything?
I mean, room to grow. I think it's going to kind of flatten out. I don't think it's going to kind of go north of 25 or whatever, ridiculous.
Is that where is it right now?
I would say kind of, people are targeting the $18 to $22 per square foot, depending on kind of your height clearance, location, and age of the product.
So that's higher than Toronto. We've had people on this podcast talk about sort of 18, maybe 20, and that's sort of the top end. And that there's a stagnation, like it's just flatlined, and that's and it might. And in
up
fact,
4.25 though. That's growth.
And in fact, there might actually be some pullback from those numbers as tenants just adopt or realize that they just can't afford it, right?
It's a supply constraint too, right? Like Ottawa has a lot less industrial available space or buildings compared to other markets. So, I guess because again, the supply was a little bit more constrained, the pricing or the rental rates were able to kind of accelerate a little quicker in that period of time. And also just demand for industrial. Everyone wanted industrial or be an industrial project property or project, people are saying I'm getting out of office and moving into industrial. So all the cards and all the momentum was kind of going to industrial because COVID, they weren't sure about retail, and multifamily was negative leverage, and different asset classes. I think it came out as a top performer for a period, but now I think those people who bought those may not be able to sell it at the pro forma price they did a year or two ago, but maybe you have to hold it a little long term. So that's retail, industrial.
We already know you're number one.
Donuts,
So
We're going to end on office, right? So we won't do
Yeah.
that. And then multifamily, and then I'll do alternative asset classes. But I think alternative asset classes include kind of these, vacant buildings, conversions, things that are going to be a different use.
Do you do like data centers, any of that kind of real off the beaten path stuff?
No, I mean, we haven't gotten there. I think the data center stuff I've been seeing is more around Toronto and Montreal and some of those centers of excellence with some of those lab and high tech and biopharma companies. We don't tend to have as big biopharma, industry here, but I think, it's really R&D related with universities. I think that's where you could see that growth in data lab center here, working with like Carleton U or Ottawa U.
It's more specialized. Is that kind of the challenge?
It's more specialized, right? So you got a little bit higher cost per square foot to build that, I believe. It was kind of like building out these cannabis industrial facilities, right? You looked at the cost to build some of these things, when I was a lender, and I was just like, it's not worth it. Like, it's not even the valuation.
Yeah,
on
and if
this
that one
is not
tenant, if
gonna
that
make
one
sense.
tenant's gone, you got nobody, right?
Yeah.
It's now just an industrial building at 12
Correct.
bucks a
with
foot or-
overbuilt HVAC.
Yeah,
Yeah, that costs $500 a square foot to build, and you're just kind of like, should have built an office building, not well. But anyways,
whatever made sense.
something
yeah.
else for $500 a foot, exactly, or multi-res building. Multi-res, so we build new multi-res. Obviously, we have EQ Homes on the home building side, so we are a believer in building product and homes for sale. We have rental buildings under construction that I think, merged out of us having all this excess land in communities. And again, thinking about community, you can't just put a whole bunch of single family homes and townhomes. We said, well, where's the people who want density live? So we looked at, leftover pieces of land, or leftover, quote unquote, and just said, hey, if we can't monetize and sell a condo building because the market just doesn't justify that right now, let's put it something else with density. And maybe the exit is now we don't have to sell, 100 homes on that site. We just have to sell the one building, or in our case, 3 buildings on that site in Orleans or something like that. So we will look to, monetize and sell certain assets. But again, the income property side, the goal is to continue growing and, creating that property management engine as well. So we don't have a strategy across the board saying we only buy and we only hold. It's really opportunistic. It really depends on the circumstance.
How are rents doing in Ottawa right now?
I think rents are fine. I think, they're kind of a lot of supply being built as well. So you look around here and you've got a few buildings downtown. You've got a lot more suburban buildings and a lot more high-rise suburban buildings that, we've been seeing, 20-story towers popping up in Barhaven and things like that. So that's been interesting to see. I think kind of the rental rates, people are targeting, call it around that $3 per square foot. I think it's probably there. It's probably going to stay or plateau a little bit for the next little period because there's some supply, I think, to work and absorb through. But real estate is really like, I always think it's just recycling of assets, right? There's always going to be a new shiny building that people want to go to, and then the old one has to reimagine, readapt, or invest to compete. So you always have an ebb and flow of people moving around because there's people who want a deal on rent, whether it's resi or office, and there's people who want the shiny building. So you'll just constantly have this like circle of recycling and regenerations of things, because you look at different neighborhoods and I put New York as an example, but like the meatpacking district, well, it's not a meatpacking district anymore, right? It's condos and hotels and towers and office and the nice what's that, the train line that they redid there,
Yeah, the High Line.
the High Line. Neighborhoods reimagine themselves, so it can be done, and you'll see similar things start to happen here with older assets or tired assets, right? You got buildings that are 50, 60 years old now that life
Remaining
cycle is-
economic life is
Exactly. Yeah.
their sunset years.
Exactly. And so on multifamily, just to finish that thought, we build new, but in terms of justifying buying old, value add buildings, that's been tough because of cap rates where financing had been. We're not typically a CMHC borrower, but that being said, maybe there's an angle there to buy more of those or buy into the value add. But I think there's real consciousness on turning tenants over and the perception of, rent evictions. And, we're talking about affordability. You really want to be the group putting out people and then putting in luxury, tenants. Maybe it's not the right optics. So that's not a market we chase. Where we do chase is the office assets.
Nice.
So we're contrarian in that.
Good segue. You should do this for a living.
So we've been actively looking at all office opportunities. We generally like Class A. Suburban has been kind of our portfolio. We don't have any downtown assets, which might have been our saving grace throughout COVID, or relative saving grace for our portfolio. We noticed that occupancy and return to office is better in the suburban portfolio that we have, and if it's close to transportation node,
So say that again. Wait, say that again.
Counterintuitive.
Yeah, no, that's why I want you to repeat it to make sure. Occupancy and
return to office. So
is greater in the suburbs.
yeah, because there's
Is that an anomaly for Ottawa? Because I would
Or is
suggest
it government influence?
it's a bit of
Yeah.
government influence, but it's also a little bit of anomaly of Ottawa. So Ottawa, you might and you will hear later in panels, is that we don't have the same return to office. We don't have the same drive of people who want to go back downtown. People have gotten comfortable where they are. They have great office homes, or suburban office. We're a suburban office. We're on Woodward, right? So we're not downtown either ourselves. But there was barriers of saying, okay, if I'm going to go return to the office, well, I have to go park. Now I got to pay for that. I don't, because a lot of people were not using their LRT pass or using the monthly cost. And then they got to go in an elevator in a 20, 30-story building with a bunch of people coughing or something like that. So we found the suburbs, free parking, no elevator, more spread out, more space. So, it appeared that people would rather, come back to those offices perhaps than downtown ones.
So in the suburbs, what percentage of those tenants are government entities?
Oh, I wouldn't know that stat.
What do you think? It's low? Like I'm
Or
trying to get
that's
at
the
like
downtown.
Yeah.
Yeah, I mean, downtown is quite heavily, tenanted with federal government. They talk about the vacancy rate being so high here, but I don't actually see it being that high. Like 10-ish% is normal any market globally.
Yeah.
So, we've been kind of artificially spoiled, maybe thinking 5% tight market. But again, we don't build a ton of office building here. So the supply has been constrained, controlling that. And I think what I've noticed, or I was concluding as I was preparing for the office panel, was I think you've just seen a power shift in leasing from the landlord to the tenant. And that's kind of where you are a little bit now. Leasing costs are a little bit more higher. Fit ups costs, inducements. You're seeing a lot more of that in the office market to attract tenants and good quality tenants, where you probably didn't see, half of those leasing costs, a few years ago or pre-COVID. So I think, leasing costs, and it's getting a little more challenging in office, which a lot of people are getting scared of. So, us being the contrarian is we believe in office will be there in some form. We believe the Class A office is kind of what's going to be the draw factor in attracting good long-term tenants. And the B and Cs, those are opportunities to reimagine and adapt and figure out if you're going to convert, what are you going to convert to? Everyone's chasing residential, but I still look at the box in a different way, right? I say the box can generate income. If my net effective rents of office is less than my net effective rent of industrial, why don't I think about making that 4-story office building downtown an industrial building, or a hotel, or a self-storage, or something else, right? Like, you really want to look at all the options, because people fixate on face rents and net rents, but what's the capex to get there? What's your acquisition cost? So how does that all factor into the overall thesis? And that's how we approach all assets, is to look at it with a really wide lens. And across our team, we bring in a diverse perspective from land, development, leasing, construction, tax and valuation, everything.
Housing commerce, right? That's the business. And you guys got to figure out what kind of commerce participates in those 4 walls and a roof that you own.
Correct.
There's one asset you mentioned that we did not cover in there, which is your condo development. I know that historically Ottawa's not had a booming condo market. So how do you make that work? Would you launch another one in the next year or two? Like, where does that market sit? And we won't rank that one we did the top 4. We'll leave it at that. But where did you put your condo project?
I mean, I won't speak for Josh, who runs EQ Homes, who is leading that, obviously. But I would just say, the condo market is definitely challenged. I mean, if you talk to developers across the city, I don't think there's many condo sales, if any. I maybe count on 2 hands how many sold last year. So condo market's dead, which is why you saw a lot of the developers who are typically condo builders pivot to rental buildings and capture CMHC programs that they were going to sell that building, but now they're just a long-term owner. And in that case, I actually don't think it's a bad thing. I think developers who fixated on the buy sell made money, but it was lumpy. This is just going to diversify their portfolio a little bit and create a little bit more of an annuity for, I'm going to say, private families, the next generation. So it's not a bad thing. I think, they kept their engine running, they kept, their trades employed, and they built buildings and were able to pivot. So, they took advantage of that time. And there were some really attractive financing rates with CMHC, RCFI, I was at a lender institution, and we heard sub 1% on like $200 million loans in Toronto for 10 years,
True.
50-year AM.
Yeah, that's true.
I'll take that deal any day too,
Yeah.
right? So,
Yeah.
that's kind of the nutshell in the different asset classes. But no one here really still talks about land, but I think land has been a little bit tough to transact on. Everyone's expectations still 2 years ago, or they have an appraisal that's a little fluffy. No offense to the appraisers, it was the right number at that time, but it's not where the market would transact now because pro formas don't work buying land at that price. So, we've looked at some projects where you put the land in for free, it still won't even work.
Yeah.
So I think land has been challenged. So you've seen a little less trades in the land department as well.
What inning are we in?
What inning? Well, I think we hit the bottom, which is nice. And, you start to see interest rates starting to creep down. So I think a lot of people have said, okay, let's start making decisions now. We feel like it can't get any worse. So let's prepare for what the next 1 year is going to be. And
You mentioned those. The reason I asked that question because you mentioned the landowners that still have maybe
out of market
yeah,
expectations.
Thank you. Yeah, have expectations. Yeah, exactly. And they can't hold on forever if they're playing prime plus 2.5, right? Like that's still a high interest rate, right? That's still 9% or 8%. I don't forget where we
Some
are.
point,
but-
reality is going to kick
Yeah.
in.
So we're not at the end. We're not in the ninth inning, right? Like I think there's still some game to be played here.
Yeah, I mean, the price of that land, the carry cost on it, it's interest only generally, but there's no revenue generally unless
Right.
you're
And
leasing it to a farmer
I mean,
or something. For some
particularly those
period of time.
condo developers. And maybe you just tell me if this is true in Ottawa, because it's still my sense in Toronto that there are a lot of condo developers that have gone long land to build the condos. The condo market's dead. They're sitting on that land. Some have pivoted to apartments, but apartments, I mean, they don't always spec out either. I mean, depending on how creative you are with your artistry and your assumptions going forwards. But like in a lot of cases, you're talking like a 6 or 7% all-in yield at the end of the day. And I don't
Right.
think some condo developers just can't stomach that when they're used to the 25, right? And so
Yeah.
there's a breaking point, I think, still to occur for the game to be over. If you know if you follow
I'm
that
loving this
analogy.
continuing
yeah,
analogy.
Sorry,
Yeah.
yeah.
No, but I think the old days of 15 years ago, seeing condo buildings and development profits of 25-30%, that was gone. Like as a lender, I saw it just get squeezed and squeezed and squeezed. Projects kind of went down to the 15% range, and then during COVID in the last little bit, projects pro-forming around 10%. You're still kind of scratching your head saying GICs are 5.5, 5.
Yeah, and that's
Why am I-
10%
why am I
assuming
taking that
that's
risk for
10%,
2 to 3 years?
and that's assuming everything goes swimmingly throughout
Yeah.
the 2.5-year build.
The risk gap's enormous.
Yeah, right.
Which is why I think you saw a lot of people just pause and shelf.
Yeah.
Like they're not going to take that risk for 10, get it to 15 or so, and then let's talk, right? And then again, what's the strategy? Are you a long-term holder of that asset? Do you care about the valuation at the exit or just the refi? So depending on your goals and the strategy,
Yeah,
the
how it works.
capital, it's a different ball game. You would maybe build it with low development profit because now you created an annuity. And if you get RCFI or some
I mean, if you
financing-
can take a 20-year horizon on it, then okay, yeah, math always kind of looks
And
nice.
get
with
rid of a
20
land loan
years,
into
yeah.
Well, especially with the amortizations available, right?
Yeah.
So if I can get the same leverage and get the AM benefit of 40 years plus,
And a 110
that'll
cover
work.
and cheap premiums and no recourse. Let's not go down that rabbit hole. Anyway, I think we're out of time. Thank you very, very much for coming on. I'd like to thank First National for powering the podcast, and thanks to Informa for hosting us here at the Ottawa Real Estate Forum.
Thank you for having me. This was a lot of fun.